what we saw last year in the market was an indicator that the US business cycle was ending and the US economy was going to go into recession. Now, and so we want to have a look to see whether that is the case. And the seasonality that we saw with the market action last year, it reminded us of the old movie, 1980 movie starring Peter Sellers called Being There. So in that movie, Peter Sellers played a simple-minded gardener. His whole life revolved around gardening. And when he talked about his world of gardening, people actually thought he was talking about the business cycle. Because he said, growth has its season. There are spring and summer, but there are also fall and winter, and then spring and summer again. As long as the roots are not severed, all is well and all will be well. And we think that's a good way of thinking of the business cycle. You have summer, it's a time of expansion, a time where in your investment portfolio you can take a little bit more risk. Summer, however, rolls into fall. It's still a time of expansion, but slowing growth. It's a time when you want to try and start thinking about removing risk. And then after fall, you get winter. It's a time of recession. You want to have as little risk as possible in your investment portfolio. And then you get to spring. And in the movie, he would always say, there will be growth in the spring. And this is a time of recovery and a time when you want to look at adding risk in your portfolio. So we think we're in fall, but we don't know when and how close we are to winter. Now, if we were a gardener and we wanted to know when is the first day of winter, we'd look at a calendar. It's December 21st. In investing in the economy, it's somewhat more difficult. And if we were to plot the historical duration of all the past bull markets, you can see there's no real pattern of duration and return. The concern is, though, if you look at where we are today, the current duration is just over 10 years. In fact, last month, we had the 10-year anniversary of this current bull market. It's the longest in history. And that duration has a lot of people thinking that it must be, because it's been so long, we must be near the end of this bull market. You can see from these magazine cover articles predicting the end of this market. A very long bull, the end is near. The next recession, how bad will it be? And the Barron's one with the best before date of 2020. So, what we would point out, though, is that even though it's been a long bull market, if you look at the actual annual return in this bull market, it hasn't been that high. We'd also point out that according to this quote from Sir John Templeton, it's not duration and old age that kills a bull market, it's euphoria. And if you look at these articles and headlines, it's not euphoric, it's anything but. It's more about skepticism than euphoria. So from that, we think we'd have a bit more room for this market to run. Now, if we want to look at the economy, and again, if we want to see, well, how far along are we and how close are we to the next downturn, if you're a gardener, you'd have certain tools to tell you when the weather and the temperature is going to change. You're going to have a thermometer. Maybe you're going to have a barometer or a wind speed indicator. We're going to look at the investing equivalent of these three things. So the first thing we're going to look at is consumer sentiment. Let's say the temperature of the consumer. And you can see these gray boxes. This is when the US has been in recession, and this is a consumer sentiment indicator. Every time it's peaked out, after a lag, you have a recession. So it's very important just to have a look at consumer sentiment, because the consumer is 70% of the US economy. So when consumers start to lose confidence, the economy usually goes into recession. On average, that lag is about 13 months. And so the question is, if you look at the far right, it looks like that consumer sentiment has topped out. Now, it did go down in January and February, but it has moved back up in March. So we're not sure if that is the case. But even if that is the case, there's still a bit of a lag before the economy would go into recession. Next one we're going to look at is wage growth, or we're going to say pressure. And the key one here is indication of 4%. Every time wage growth goes above 4%, you typically, after a lag, you get a recession. If you can see right now, we're at about 3.4% wage growth just recently in the US. So we're not at that 4% level. And also, we still have that lag, average lag of 29 months. So again, not indicating a recession. The last one we look at is credit spreads, or let's say the speed of lending in the economy. And typically, credit spreads, it's an indicator of how hard it is for businesses to borrow money. And you can see credit spreads typically move up before a recession. But if we look at where we are now, you can see credit spreads have been quite stable. They did spike in December with the sell-off in the equity market, but they've moved back down. So again, credit spreads remain quite positive. So in the real economy, we don't see signs of a recession. For predicting the weather, the other thing that is useful is looking at historical patterns in weather. So we're going to look at a couple historical patterns to see if that can tell us what we might expect in the next year. So first of all, let's see what the pattern looked like last year. And what this is it's a chart of the valuation of the S&P 500. So it's forward PE, price earnings multiples. And from start to finish, you can see that PE multiple or valuation contracted by 4.5 points. So why did that happen? Because last year the market was down slightly and earnings were up 24%. That contracted the valuation. And this was in the backdrop of strong economic growth. This should have been a very good environment for equities and for stocks, but it wasn't. So again, that's a historical pattern. Where have we seen that pattern in the past? Well, let's go to 1984. This was a time period where the S&P was up relatively flat, 6.3%. The economy was very strong, up 7%, earnings 21%, so strong earnings. And again, you saw that contraction in valuations. What happened in the market the next year? It was up 33%. 10 years later, it was the same pattern. See, a market was basically flat. You had strong economy. You had strong earnings. You saw a contracting valuation. What happened in the market the next year? Up 37%. So based on these historical patterns, we maybe think that 2019 could be a very good year. And actually, we've gotten off to a very good start.